am Mr. Frederick, and today's class is Business Finance. I want us to finish on the topic on ratios. So for the last two sessions, I've been giving you notes on ratios, the formulas which you can use to compute various ratios. You find that ratios are normally grouped in 5 categories. So today I want us to look at the calculation part of it. Now I have this paper here. This is November 2015. I hope you all have it. So this is November 2015. November 2015 paper. The code of this paper is 1903/203 and 1907/203. This is craft certificate in supply chain management and craft certificate in business management. So there is this question here, question 13A. So we have here question 13A. We want to start with question 13A. Now the question says, the following are the financial statement of Pemba Limited as at 31st December 2012. So we have Pemba Limited. We've been given the income statement as at 31st December. We have the 2012 and the 2013. We have sales, we have cost of sales, gross profit, operating expenses, profit before interest and tax, interest paid, profit before tax, tax due, and net profit after tax. Then we have Pemba Limited statement of financial position as at 31st December. We have again 2012 and 2013. Figures are in Kenya shillings. So we have non-current assets. So we have non-current assets, we have premises, we have equipment, we have motor vehicles, total non-current assets. Then we've been given the current assets. We have accounts receivable, bank, and inventories. Current liabilities, we have accounts payable, we have taxation, we have bank. Then financed by share capital, we have profit and loss, then long-term loan. Then we have for each year, calculate. So we are required to calculate for each year. 1, the current ratio. 2, quick ratio. 3, average debt collection period. Next, debt equity ratio. Next, interest coverage ratio. Then using the answers in Roman 1 above, compare the liquidity and gearing position of the firm between the two periods. So this is the question we have at hand. Now let's start with Roman 1. We have current ratio. Current ratio. So how do we get current ratio? We say that current ratio equals to current assets. So we have here current assets or current liabilities. Current assets over current liabilities. That is how that's how we get current ratio. Now remember, we are required to calculate for each year. So we have here 2012 and 2013. So we have current ratio for 2012. Now in this case, we are going to go to the balance sheet or the statement of financial position. So for 2012, the total figure is so let's get the total. The total has not been given, so let's calculate it. Now we have 29. We have 2966. You add 120. You add 1759. So that is 48, 45. That is 48, 45. So we have here 48, 45. You divide by, we have current liabilities. So current liabilities, the figure has been given, I think it has been given, that is 39.15. Let's just confirm. So we have 13.95, add 13.44, you add 1176. So that is 39.15. It was given by the examiner. So we have 39.15. Now let's divide this. So we take 48, 45, divide by 39.15. So this gives us 1.24. So we have 1.24. So you say 1.24 is to 1. That's how we write ratios. So for 2012, current ratio is 1.24 is to 1. Now we go to the other one, that is 2013. We go to the other year, that is 2013. So let's get the current assets. We have 1880. You add 200, you add a 1021. So this gives us 3101. So we have here 3101. We divide by 3138. 3138. So 3101 divided by 3138, that gives us we can say 0.99. So you can have it as 0.99 is to 1. 0.99 is to 1. So that is the current ratio for the year 2013. Now the other one is quick ratio. Quick ratio. So quick ratio is given by, this is 1, 2. So we have quick ratio. Now you take current assets. You take your current assets minus inventory. You divide by current liabilities. You divide by current liabilities. So that is how we get quick ratio. Current assets minus inventory, or divide by current liabilities. So current assets, we have the figure up there as 4845, subtract inventory. Inventory for the year 2012 were 1759. So we divide by 3915. So you take 48, 45. Now we have 48, 45, subtract 1759, that gives you 3086. You divide by 3915. So this gives us 0.79. So we have here 0.79. Now I've decided to leave my answer in 2 decimal places. I am using 2 decimal places. 2 decimal places. So next we have this was 3101, subtract inventory for the year 2013, which is 1021, divide by 3138. So we have 3101, subtract 1021. That gives us 2080. You divide by 3138. So that is 0.66. So this is 0.66 is to 1. 0.66 is to 1. So that is our 66 is to 1. So that is our quick ratio or acid test ratio. The other name for quick ratio is acid test ratio. Sometimes the examiner may use this term, acid test ratio. So it's one and the same thing. Now Roman 3. So next we have average debt collection, average debt collection period, average debt collection period, average debt collection period. This is a neck paper. So we have average debt collection period. Now how do we get this one? Average debt collection period. So you take average debtors, so this is average debtors, divide by credit sales. You multiply by days in a year, or number of days in a year. So you take average debtors, divide by credit sales, multiply by number of days in a year, or simply days in a year. Now, if the examiner has not given you, the number of days in a year, you are at liberty to use 360, 365, or 366. You can use any. But the moment the examiner has given you a figure, you are bound to use that figure. Now, for the year 2012, we have accounts receivable as 2966 divided by. Now in this question, we've not been given the proportion of sales which were on credit. That is another thing which you have to have in mind. The examiner has not given us the proportion of sales which were on credit. So we are going to make an assumption that all sales were on credit. But the moment the examiner has told you that, let's say 80% of sales were on credit, you need now to calculate the credit sales. You need to calculate the value of credit sales. But this is not the case because the examiner has not told us. The amount of sales which were on credit. So we are going to assume that all sales were on credit. Now for the year 2012, sales were 8580 multiplied by, let's use 365. Let's use 365. So we have 29. We have 2966, 2966. You divide by 8580. Then you multiply by 365. So this gives us 126.1, you can say 18. So this is 126, sorry, 0.18 days. So that is the average collection period for the year 2012. We go to the other one, 2013. Now remember the formula says average debtors. So for the year 2013, remember we have now the opening debtors. The opening debtors for the year 2013 are the closing debtors for the year 2012, which in this case were 2966. So here we are going to have 2966 plus 1880. So you take 1880 divided by 2. That will give you average debtors. Then you divide by the credit sales for the year 2013. So credit sales for the year 2013 is 9780 multiplied by 365. It is 365 simply because we've not been given the number of days in a year. So first of all, let's compute the average data. So we have 2966 add 1880, then you divide by 2. So that will give us 2423. Now take 2423 divided by 9780. 9780. Then you multiply by 365. So this is 90.43. 90.43 days. So that is the average debt collection period for the year 2013. Next, we have debt equity ratio. So we have here debt equity ratio. Debt equity ratio. So we are simply going to take total debt over equity or total equity. So for the year 2013, for the year 2013, so we didn't have long-term loan. So we had a bank overdraft. There was a bank overdraft under current liability. We have bank there. So this is 1176. You divide by equity. So equity is, we add, so we have 3500 plus 5130, that is 8630. So we have 8630. Now let's get that ratio. So this is 1176 divided by 8630. So this is 0.14. 0.14. Now for the year 2013, we have a bank overdraft of 1612 plus 399. You divide by 77778. You divide by 778. So let's do that addition. So you have 1612 plus 399. You divide by 77778. So this is 0.26. 0.26. Next we have interest coverage ratio. Next we have interest coverage ratio. So we have here interest coverage ratio. So how do we get interest coverage ratio? You take earnings, so this is earnings before interest and tax. You divide by interest charged. Interest charged. We divide by interest charged. So you take earnings before interest and tax, divide by interest charged. So we have 2012. So 2012 earnings before interest and tax. So we have profit before interest and tax. This is 1456 divided by interest charged. So we have interest paid 479. So this is 1454 divided by 479. So that is 3.04. So this is, Now we have non-current assets, 5.3 million. Then current assets, we have stock, we have debtors, we have cash at bank, then we have cash in hand. That is, it gives us a total of 4.8 million. So you add 4.8 million to the 5.3, you get 10,100,000. Then we have capital and liabilities. We have ordinary share capital at Kenya shillings. That is each at Kenya shillings 20 each. We have retained earnings. We have 12% preference shares, long-term loan, 8% debentures. Current liabilities, we only have one item, and that is creditors. Then additional information. 1. Ordinary dividends were paid at 10%. Next, market price per ordinary share is Kenya shillings 25. Then calculate. So Roman 1, we are required to calculate the current ratio. We are required to compute the current ratio. So how do we get current ratio? Current ratio, I've said, is current assets. So you take current assets, divide by current liabilities. You take current assets, divide by current liabilities. Now current assets, the total have been given by the examiner as 4.8 million. 4.8 million. Then current liability, we only have one item, that is creditors. The figure is 1980, like that. So let's get that. So we have you can just have it as 4,800 to simplify your work. Divide by 1980. So this is 2.42. 42 is recurring. So we have 2. Just a minute. It is 2.42, yes. So this is 2.42. 2.42. So that is our current ratio, 2.42. Next, we have acid test ratio. Now you see that in this paper, the examiner has used this term, which I told you just some few minutes ago, that sometimes the examiner may use another term. And here is a case where he has decided to use acid test ratio instead of quick ratio. So acid test ratio equals to, you take current assets minus minus inventory, you divide by current liabilities. So current assets, we have it as 4.8. We subtract the inventory, which is the other name for inventory is stock. So we have here 800,000 divided by 1980, like that. So we have minus 800,000, that gives us 4 million. Then we divide by 1980. So this is 2.02. So this gives us 2.02 is to 1. Don't forget that this is ratio. So we have it as 2.42 is to 1. Then this is 2.02 is to 1. Next, we have dividend per share. So we have here dividend per share. Dividends per share. So dividends per share, we are told in additional information number 1 that ordinary dividends were paid at 10%. So DPS will be, you take now the 10% times 10% times the par value. The par value of these dividends. So this is 10% of the par value of these shares. Sorry, the par value of these shares is shillings 20. So the DPS is shillings 2. The dividend per share is shillings 2. Finally, we have dividend yield. Dividend yield. Now, yield is normally computed based on the market value. So this is dy equals to, you take the DPS, that is dividends per share, divided by market price per share multiplied by 100, so that your answer can be in percentage form. So this is dividends per share over market price per share. So in addition formation number 2, we are told that the market price per ordinary share is Kenya shillings 25. So here we are going to have 2 divided by 25 times 100. 2 divided by 25 times 100. Now let's have that. So this is 2 divided by 25 times 100. So that gives us 8%. So the dividend yield is 8%. So that's how we compute the ratios. These ratios are not hard. We just need to do a lot of practice. Keep on doing a lot of practice. That's when these formulas will stick in your head. Do more practice. You have the past papers. I told you to take a copy of those past papers. So go through those questions. If you find any challenge, don't hesitate to call me or to text me. So this will be the end of our today's sessions. Bye for now.